All right, exciting week in the markets this week. S&P 500 up pretty good. The bulls definitely led the week. The thing that they don't have going for them is that they could not break out of that trading range. So we've been in this trading range for the past few weeks, and they just haven't been able to break to the upside. So that's not really good for them. The other thing that's pretty exciting about the week is that we have the monthly readings, and so we know that the S&P 500, the reading against the All World X USA Index and Treasuries, also the relationship between small and large cap, and then also growth and value. I want to talk a little bit about that. And then I also want to show you what many call a bull trap or a bear trap. And then finally, I want to show you the yield curve and mention that nobody else seems to be talking about it. The way that they frame it is not this way. So we're going to look at that. So first things first, monthly momentum finished negative for the month. This is a warning. This is a warning sign for a bear market. Doesn't mean it's going to happen, but it is a warning sign. We got a sell signal there on the monthly basis. As far as large caps versus small caps, large caps are still greatly outpacing small caps. Not even close. Large caps are the clear winners. And then when we look at growth and value, they've been going back and forth. Last month it was value that was ahead. This month it is growth. And so you want to continue to focus on growth right there. Now, this next chart that I'm going to show you is a monthly chart of the S&P 500, and it's a line chart, and this is what people call a head fake, a bear fake, or a bull trap or a bear trap. All right, so let's check it out. All right, let's talk bull and bear traps. Now, before you can look and spot bull or bear traps, there are really two things that you have to understand. So the first is how do you define a trend? And then secondly, how do investors behave if they're trend followers? What is a strategy that they do? So the first things first is a trend is simply, an upward trend is simply a series of higher highs and higher lows. A downward trend is simply a series of lower lows and lower highs. The way that investors can take advantage of that if they're a trend follower is they simply buy the higher highs. Or if they're bullish, and if they're bearish, then they could sell the lower lows. Let's look at how that worked out right here. So here's the 2000 crash of the S&P 500, the bear market. Probably call it a bear market's better. So we've got a bear market, obviously lower highs and lower lows, and then something changes right here. Changes right here at a very, very minimum. Trend followers right here said, oh, it's different. Polarity of the market has changed, and now it's time to be bullish. And that worked. They could buy the higher highs all the way until right here. So this right here, this was a bull trap. You see I made the high, and then it goes down below. Now, something to note is that a lot of times you'll see the volatility increase here, and that's simply because people are stopping out. Investors are stopping out. They'll often put a stop below the last leg up in what this turned out to be, the bull trap. So again, worked pretty good here, and then so here we are right here. So is this a bull trap? That's the question. We've got a higher high, and we've got price coming back down in. This was a down month for the S&P 500, so we'll see if it continues down and breaks below these levels, or if in fact we do see another higher high after this. The inverted yield curve has been getting a lot of press lately, and what that means is that when they're talking about the inverted yield curve, they're saying that the 2-year, or they're reporting that the 2-year Treasury is yielding higher than the 10-year Treasury. Now, what's interesting is that most of them that I've read, all the articles about it, are stating how it is a predictor of a recession, or each time it has happened, there has been a recession. Now, yes, and this is 1950. So yes, this is true. This is true. But what they're not saying is there have been times when it has indicated a recession and not happened. And so that was in 1965 and in 1998. And so the point that I'm trying to make is that just because there's a signal doesn't mean that the signal is correct. We have lots of signals for bear markets and lots of signals for recession. But every time they happen, it doesn't mean that the recession or the bear market happens. The point is that these oscillators and these indicators and the yield curve do not cause market action. They don't cause it. And so they just happen to be historically events that when they happen prior to in certain instances. But again, the point is that they have also happened prior to, and the market hasn't responded the same way. So there are a lot of factors that go into people's decisions when they buy and they sell, and to put it all on one indicator or one reason, that's just not. Just people do things for different reasons. I mean, it's that simple. And think about all the market participants. So, all right. Hey, with that, hope you have a great week. It's the end of the month, so I'll be sending out the 401k emails if you're on that list. And then, hey, if you agree with if you think that we're going to go into a recession here pretty soon, or in the next 18 months, whatever, let me know. Let me know in the comment section below. And if you like the videos, thumbs up, subscribe if you're not subscribed, and we'll talk to you next time.